Okay, so good morning, everyone. Welcome to today's macro snapshot. We are, what are we? Thursday, June the 27th, 2024. I'm recording this about 7:30 in the morning. So, guys, a lot of markets are fairly tight in fairly tight ranges. Yesterday, what we did see was a pretty strong move up in the US dollar versus the yen. This is the daily chart here, and that's kind of coordinated with or interrelated with sort of bond yields, US bond yields, which we'll talk about in a second. But just in terms of the yen, I mean, obviously, if you look at here, USD, JPY, it's a very, very strong uptrend. We all know that it's been going on for the last 6 months or so. There's been a lot of talk of intervention. A lot of people, if you look at this little red thing here, saying, "Oh, the Bank of Japan will have to intervene on the instructions of the Ministry of Finance." But the question is, if you look at Kanda, who's the chief FX sort of representative at the Ministry of Finance, if you go back to this period here, he did say that what is excessive and unacceptable, reading between the lines, is a move of about 10 yen in 1 month. And if you actually look here, if you look down at the beginning of, let's say, the 12th of March here, you've got a level of about 147. And as you guys can see, if we actually look, in about 4 or 5 weeks, it got up to about 157 or so. So this is what 10 yen in a month looks like. And as you can see, that's when they intervened and spent about 61 billion equivalent in US dollars. So it's not cheap. And there's also some suggestion that they have to they sell treasuries, their holdings of US treasuries to fund that. They receive the US dollars and basically, with that money buy yen, thus forcing the yen up in price. So that's why the repercussions of the market, if the market perceives that the Ministry of Finance or the Bank of Japan is basically selling US treasuries on the hint or the risk of intervention, that will put upward pressure on the yields in the US treasury space. But as you can see, if we now look at this period here in the last month or so, if I just I'll try and grab this sort of orange circle here. Let's see if I can do that. Yeah. No, actually, that's a bit strange. Why can't I do that? Okay, so as you can see, we're not exactly at that level. What that level would be a bit higher up, maybe 164, 165. So a lot of people are saying that maybe the new line in the sand could be a little bit higher, maybe in 164, 165, something like this. Because at the end of the day, yes, the yen has depreciated against the US dollar, but it's been relatively orderly and not particularly excessive, and it's based on fundamentals. And these are all expressions which are used by the Ministry of Finance. Is this excessive? You could argue no. Is it one way? Well, maybe you could say it's one way. Is it disorderly? You could say no. And is it based on fundamentals? You could say, well, yes, it is based on fundamentals because the US yields differential with the Japanese yields are very high. So the other thing as well to think about is that they like to operate in low liquidity environments to get more bang for their buck, so to speak. They being the Ministry of Finance, the Bank of Japan. So one could argue that maybe the most logical thing to do if they were to intervene or wanted to intervene would be to wait until tomorrow's PCE reading, which is obviously 8:30 Eastern time. And that could cause, that's expected to be a little weak or a little bit soft. Now, that could help them in two ways. That could help them if the US dollar weakens naturally against the Japanese yen, they wouldn't have to intervene. And on the other hand, that would be a risk event. And if that passes, let's say, for example, that number comes in maybe slightly hot and the US dollar rallies against the Japanese yen, maybe they could use tomorrow afternoon, let's say after lunchtime or so, in low liquidity. So that period of 1, 2, 3, 4 p.m. before the FX spot market closes, which is what they've done in the past, is on the Friday afternoon, a low liquidity environment. So those of you around tomorrow afternoon, we'll be looking at that just to see, there could be a possibility of an intervention in that low liquidity sort of windows. That's kind of interesting there. In the meantime, what we did get is a lot of action in the US Treasury space. So we can look at a couple of things. Let's look at some of the yields. We can see here yesterday, not a huge amount at the front end. This is interesting. You see here the 2-year yield. It's essentially been trading, at the bottom of its range, sort of creeping up a little bit. Again, this is based on the idea that the Fed, the market is fairly comfortable at the moment, saying that the Fed will cut twice, around about 50 basis points are priced in for cuts by the end of the year. So the front end of the curve, by which I mean the 2 and the 3-year, is relatively anchored. Where we start to see a bit of movement, you see here the 5-year yesterday, the 5-year yield moved up quite a lot. And then, of course, if you go out to the 10, you can see here, and the 30. So what you can see here is that at the long end of the curve, we got the yields going up quite a lot yesterday. And that is reflected if you look at, let's say, the 2s30s on the yield curve. You can see there was a long end led bear steepener. So basically the long end yields ripping higher, which means the price going lower, which is steepening the curve. And that's just basically probably on this idea that inflation remains a little bit sticky. The Fed is not necessarily going to be hiking rates anytime soon. Absolutely not. And we know what they're going to do in terms of cutting. The market is saying, well, they're probably going to do it once or maybe twice this year. So therefore, the pressure when we see sort of a relatively strong economy and sticky inflation is being borne by the long end of the curve. And probably a little bit of this as well is this idea that maybe going back to Japan, that the Japanese yields are going up a little bit. And basically what we saw, you have to say, well, why did all this sort of suddenly happen in the last 24 hours? And I think the catalyst started off in the Asia Pacific session, not last night, but the previous night. So that'd be Tuesday night. And that's just on the back of the fact that we had, first of all, higher than expected inflation in Australia. We had, fairly nasty inflation reading from Australia. And then yesterday we had a higher than expected, was it yesterday? The Canadian CPI. So basically we had Canadian and Australian CPI a bit higher than expected. And I think the market's saying, maybe this inflation in developed economies is a little stickier than we had hoped. And so what we started to see is a sell-off in Australian bonds in that session. Canadian bonds as sold off quite aggressively. And I think there was a bit of a spillover into the US space. And that pushed up the US yields, which of course pushed up the US dollar against the Japanese yen, et cetera, et cetera. So there was a whole kind of concatenation sort of events there pushing up the US yields and the US dollar. So if we get to the US dollar here, no, so sorry, just keep on the yields here. So the thing is that we have a bit of data this morning. I would say it's not going to be massively market moving, but there is, data, and if we put it all together, that could be something. So let's have a look. We have final readings for the GDP, but that's from the first quarter. So as you see, it's the third reading. So I don't know how market moving is going to be, but I suppose if it's revised upwards, which I think happened last time, if I remember well, that could be seen as a little hawkishly. We have, a couple of subcomponents there. The other thing to be looking at as well is the initial jobless claims, 235 as expected. Now that is creeping up. It's by historical comparisons, that's still a low number, but it is creeping up. That would be dovish. That would indicate that the labor market is cooling. The one I'm looking at is continuing claims at 1.828 million is expected, which looks to be exactly the same number as last time, which is a bit weird. I don't wonder if that's a mistake, but basically continuing claims is starting to tick up a little bit. And is that indicating that people are finding it harder once they, leave a job or are fired to actually find a new job? Because continuing claims are people who are obviously continuing to file in insurance benefit claims. So that's something to be looking at in terms of evidence that the US labor market may be cooling sort of slowly. That we also get durable goods for the May number. That's a preliminary number, which is a pretty choppy number. But so the thing is that in terms of just direction for today and this afternoon, let's look at jobless claims, continuing claims, and maybe any sort of surprises for the GDP readings. But again, I emphasize it's the third reading, and I think the market's had time now to absorb most of that. Of course, this is going to be leading into what happens with the PCE tomorrow. And if we actually look at some of the bonds, I just want to look at the bond action here, if I can. Again, just looking at some of these US yields, let's say for example the 5-year here, it's gone up quite a lot, and again for the reasons we just sort of spoke about. It's going to be interesting. Core PCE tomorrow, that's expected to be, well, I'll speak about that tomorrow morning, but that's expected to be pretty soft. If that is not soft, I think there's room for quite a significant market repricing, in the, all across the curve actually, but especially let's say in the 5s and the 10s going further up. On the other hand, that could go down tomorrow, but maybe not a huge amount because it is expected. The same again with the dollar. If we look at the dollar, which is here, just the dollar index. As you see yesterday, the dollar had a pretty, sort of strong move upwards on the back of those strong US yields, coming off just a little bit. We see overnight that, the antipodeans, which had been pretty, strong yesterday, just coming off a little bit, ultimately still trading in a range. There's the Aussie, there's the New Zealand. which was whacked down a little bit yesterday. And what we are seeing is that the New Zealand economy, this is showing some cracks. We had some news yesterday from New Zealand that the Treasury is worried that, the tax base is falling, spending's getting too high, so they're going to probably have to cut some spending programs in New Zealand. So we are actually, just in terms of those antipodean currencies, seeing the Aussie, comfortably outperform the Kiwi just at the moment. Overnight, though, getting back, we saw that, the Canadian dollar had sold off a little bit against the US dollar, but now just sort of stabilizing a little bit. And I think, probably today we're going to get relatively stable markets and waiting for the, as I say, the PCE tomorrow. The other thing which we do get today, apart from initial jobless claims and continuing claims and durable goods, we also get the 10-year, no, sorry, the 7-year auction. Yesterday's auction in the fives actually went quite well. Stopped through by a little bit. So it went quite solidly, which didn't really prevent the 5-year bonds from selling off just a little bit. But that risk event is now gone. And, ultimately, to be honest, there has been relatively good demand. We saw for the, what was it, the 2-year and the 5-year. So let's see how the 7-year goes today. That's going to be something interesting to look at. Apart from that, the equities seem to be pretty stuck, at least the US equities. We just take, let's say, the S&P 500 ES futures, as you guys can see here, just trading along the highs, more or less a bunch of inside days, just a range trade there. Not a lot to say. I mean, we've got an interesting situation in the equities where, very, very strong earnings are kind of being sort of priced in. So you've got to ask yourself, if those earnings are justified and companies continue to make a lot of money, does that mean ultimately that the bond yields have to go up a little bit to kind of factor that in, which ultimately could cause the equities to sell off for those higher bond yields? Or could it be that the earnings actually ultimately disappoint as we get into the second half of the year, and therefore the equities sell off? So for me, I think, I mean, if I stretch this out, one could argue it's just, maybe not so much sideways as a slight, as sort of a subtle sort of flagging formation here, bull flag. Maybe could be some more upside in equities, but I think increasingly, strong upside is going to be harder and harder to achieve. But we shall see. If we look at the Nasdaq here, similar kind of situation, actually a slightly weaker price action here, but one could argue that this is sort of sideways, maybe a slight sort of flagging formation. So I suppose the market waiting for some more catalysts. Again, that could be the PCE tomorrow. Of course, tonight we have the first the first debate between Trump and Biden. I forget the time, normally about 8:30 or 9 p.m. Apart from the fact that it's probably going to be quite painful television, painful viewing, it will be interesting to see if there's any market reaction. We know that in theory, Trump could be a little more protectionist, more tariffs, less tax, maybe higher spending. Both of them are going to have higher deficit spending. So personally, I don't know there's going to be any trading opportunities in that. I guess we'll watch it and just see just how the market reacts. Curious to see how the US dollar reacts, how the bonds reacts, and actually the equities as well. And indeed, if they come out and say anything sort of new and fresh, I expect it's probably just going to be a fairly aggressive and tedious non-debate. But hey, we have to see what's going on, and there won't be another debate for many, many months. So it'd be interesting to just see a little bit of what's going on there. Apart from that, guys, that's about it. Again, as I say, probably the market's just going to see what happens in the debate, the presidential debate, see what happens with the core PCE. Keep your eyes on the US yields, the 10-year yields, and the Japanese yen. And then, of course, over the weekend, we have round one of the French elections, which we will probably talk about a little bit more tomorrow. Actually, the final thing I just wanted to share with you, just oil, by the way, just trading in a range, is just what's expected in terms of the Bank of Japan, just in terms of what's going on over there. So if we look at the Japanese, what's priced in, we can see that in the next two meetings, so the end of July and then September, we can see about 6 basis points, then a further 6 basis points. So they're only ever expected to hike by 10 basis points, not 25. So as you guys can see here, the market is starting to price in, not exactly one hike at the next meeting, and then maybe 1.2 hikes by the time we get to September. So this is slowly grinding up. But, see, at the end of the day, we're talking 6 or 7 basis points, and then maybe after the second meeting from now, 12 basis points, which is not nothing in the context of Japan or the Bank of Japan. So, slowly, the market is expecting the Bank of Japan to, edge up those yields. And again, that is going to be, extrapolated out to the broader sort of bond market globally. And ultimately, who knows if the Fed starts to signal some kind of cutting cycle and the US economy weakens, but on the other hand, the Bank of Japan is indicating that, they're happy with inflation going up just a smidgen over there. There could be the differentials coming in, and that could lead to US dollar JPY actually coming off sometime, who knows, maybe in Q3 of this year. We shall see. Okay, guys, I'm going to leave it there. Have a great day, and we'll keep in touch, no doubt. Thank you. How do I stop recording? Boom.